Kia ora and welcome everyone. Today, we dive into the world of bookkeeping, a crucial foundation of any business. Bookkeeping ensures accuracy in financial reporting and decision making. Whether you're a small business owner or someone looking to learn the basics of bookkeeping, this training video is perfect for you. It demonstrates how bookkeeping provides valuable insights into your business financial health. Let's get started and explore more about bookkeeping. In this introductory bookkeeping training, we aim to achieve 7 key learning outcomes. This includes exploring the role of bookkeeping and the key concepts that underpin the bookkeeping process. We identify the primary sources of bookkeeping data and detail specific types of business transactions. The training also covers the rules for implementing a simpler bookkeeping method known as single entry. Additionally, we illustrate how to record business transactions over a period using a cash book template. Towards the end of the session, we learn how to create a statement of financial performance for a business. What is bookkeeping and what role does it play in a business? Generally, bookkeeping is a very broad topic, but for most small businesses, its roles can be summarized as follows. It helps record business transactions, allowing you to track the flow of money in and out of the business. Secondly, it serves as a tool to generate accounting reports that aid in managing the business. For example, having proper documentation of income and expenses helps determine whether your business is profitable. And lastly, it provides a method for managing business taxes. If a business has made a profit by the end of the year, it will likely owe taxes. Without proper accounts, it is impossible to know how much tax is due. Whenever a business transaction occurs, whether it involves sales or purchases, receiving or paying money, or owing or being owed money, it is typical for the transaction to be recorded in a document. This document serves as the source of all information entered into a business accounts. The common documents used to record business transactions for a small business include invoice issued. When a business sells goods or services on credit to a customer, it sends an invoice. This document requests the customer to pay the amount owed. Invoice received. When a business buys goods or services on credit, it receives an invoice from the supplier. This serves as a reminder to pay the amount owed. A credit note. A document sent by a supplier to a customer when goods are returned or overpayments are made. It is a negative invoice. Receipt issued. When a business receives payments for goods or services sold, it issues a receipt to acknowledge the cash received. A receipt received. When a business makes a payment to a supplier for goods or services, it receives a receipt from the supplier as confirmation of the payment. A checkbook or check butts. If a business uses checks to make payments, the retained check butts in the checkbook serve as source documents providing evidence of payments made. A statement of accounts. A document sent by a supplier to a customer that lists all invoices, credit notes, and payments received from the customer. Last but not the least, bank statements, an independent record kept by the bank, detailing all withdrawals and deposits made by the business. In addition to this, other source documents like purchase and sales orders, payment vouchers, memos, and more may also be used. It's essential for businesses to keep records of these documents, either electronically or manually, as part of proper bookkeeping. To summarize, the documents discussed relate to the main types of transactions that a business makes and must record in its accounts. In this example, we look at the flow of transactions with a source document between the business, a customer, and a supplier. A cash sales transaction, a receipt is issued. Secondly, a credit sales an invoice is issued to the customer. A sales returns transaction, a credit note is issued to the customer, reducing the original invoice. A cash purchases transaction, a receipt is received. A credit purchases transaction, an invoice is received from the supplier. And a purchases returns, a credit note is received from the supplier. In other words, you should focus on receipts transactions. These are typically receipts for cash sales or payments from credit customers for credit sales. Similarly, payments transactions usually involve payments for cash purchases or payments to credit suppliers. It's crucial to remember that business transactions are documented on source documents, and these scattered documents are then used to record the transactions. We will now explore how to track business transactions in a cash book using the single entry bookkeeping system. Who can use the single entry system? The single entry system is simpler than the double entry system, making it a great choice for small business owners just starting with bookkeeping. Its straightforward nature allows you to easily record transactions without the difficulties of a more advanced system. So, who are these business owners? These are typically small business owners, especially sole traders, who often operate with low transaction volumes and have simpler revenue streams, usually involving basic or minimal expenses. These businesses often have a small customer base and operate on a modest scale. The simplicity of their operations makes it easier to manage finances and maintain efficient bookkeeping using the single entry bookkeeping system. What is the single entry system? In the single entry system, the cash basis method is used to record business transactions. This means you only document cash that comes in and goes out in the cash book. For example, you record income in the cash book when cash is actually received, and an expense is recorded when cash is paid. The key principle is that any business transaction involving cash received or paid must be noted in the cash book. However, transactions related to credit sales or purchases are not entered in the cash book. Instead, they are kept in a separate record. We now look at how a business can keep records in a cash book. I'll demonstrate how to record business transactions in a cash book. First, I'll show you how to record transactions in a manual cash book. And next, I'll demonstrate how to record them using an Excel template. Before we begin recording transactions, let's review the key details that need to be included in the cash book. Remember, these details are already found on a source document. Firstly, the date. This is important as it determines the reporting period for the transaction. Secondly, purpose or description. This explains the reason for the amount received or paid. Thirdly, the amount. This records how much was either paid or received. And last but not the least, the charging account. This indicates whether the transaction is categorized as an income or expense. Keep these important details in mind as they will help us fill out the cash book accurately. Click on link 1 below to download the activity we'll use for this demonstration. In this activity, we look at how Cora balances her role as an environment officer while also running Auntie Cora's Pizza Hut. In September 2024, she records various transactions including pizza sales, customer returns, payments for suppliers, and expenses for utilities, staff wages, and maintenance. She has asked us to record these transactions in a cash book for her. Here's how to record transactions in a manual cash book designed to track daily, weekly, monthly, and even yearly cash transactions. We use the white pages to record daily and weekly transactions, and at the end of each week, we sum up all the weekly transactions on the blue page. And finally, at the end of every month, total all the monthly transactions on the yellow page. I will now complete the activity and then go through the solution afterwards. In week 1, from the 2nd to the 6th, total sales are $300, with a $25 refund to the customer and an electricity payment of $101, totaling $126 in cash paid out. This results in a net profit of $174 for the week. For week 2, from the 9th to the 13th, sales total 250, while 326 is paid for the ingredient supplies and a casual work. Note that the transaction on September 10th is excluded, as it was not a cash transaction. According to the cash basis method, only transactions involving received or paid cash are recorded. This leads to a net loss of $76 for the week. In week 3, from the 16th to the 19th, total sales are $200, while cash expenses amount to $485 for rent, oven maintenance, and a $65 payment for an invoice dated September 10th. Following the cash basis method, the transaction is now recorded as cash has been exchanged. Additionally, the September 19th transaction is excluded because it was a credit sale. This results in a net loss of $285 for the week. Having recorded each week's transactions, we now summarize them on the blue page. In September, total sales amount to $750, representing the cash received during the month. Operational expenses, however, totaled $937, resulting in a net loss of $187 for Auntie Kora's Pizza Hut. Consistently recording weekly and monthly transactions like this makes it much easier to summarize at year end. Now, let's move on to the yearly reports, which we will summarize on the yellow page. If monthly transactions are completed throughout the year, the year-to-date net loss would be $187, based solely on September's results. Essentially, this yearly summary serves as the statement of profit or loss, which is crucial for evaluating business profitability and determining tax obligations. You've now seen how to record transactions in a manual cash book, demonstrated in a standard format, though you can choose your own style. Remember to keep your records neat and organized at the end of the reporting period to ensure easier understanding and summarization into reports. You may have also noticed the challenges of manually recording transactions and summarizing them for reporting. We will now shift our focus to the Excel template. Please click on link 2 below to download and open the Excel template that we will use in this activity. On this Excel template, it has the option of setting up your chart of accounts, recording transactions, and generating a statement of profit or loss. Now, based on the activity, let us first set up the chart of accounts for Auntie Koro. The chart of accounts classifies whether the charging account is an income or an expense. Next, let's record the transactions for the month of September. You can now see that all transactions have been recorded, noting that every transaction has a date, a description, an amount, and an account recorded under, whether an expense or an income, depending on the nature of the transaction. Let's look at a report that can be generated from this data, called the Statement of Financial Performance or Statement of Profit or Loss. This statement summarizes income and expenses over a specific period, showing whether the business has earned more income than expenses, which is a profit, or incurred more expenses than income, a loss. In this report, income represents cash received, while expenses represent cash paid. In this tab, we generate a profit or loss statement to assess Anticora's financial performance for September 2024. The report shows that Anticora's Pizza Hut incurs a loss of $187 for the month, with total net income of $725 and operating expenses of $912. While this report covers just 1 month, the same analysis to the entire year from January 1st to December 31st, 2024. As a business owner, understanding your annual profit or loss is essential, as it reflects your overall performance and also influences your tax applications to the Inland Revenue team. Click on link 3 below to download the solution to our activity. You can then compare your answer with the solution provided. To summarize what we have covered, remember that bookkeeping helps record business transactions. It also serves as a tool to generate reports that provide insights into your business health and monitor your taxes. Additionally, every business transaction should have a source document, as these are the data for your cash book. The cash book records all cash received and cash paid. At the end of a period, these records help generate a profit or loss statement to determine how profitable your business is and to monitor your tax obligations. Keep in mind, consistent bookkeeping should become a regular habit for your business. Thank you for watching this training video and completing the activity. Feel free to contact the team if you need further assistance with bookkeeping.